3, 2, 1.
Blast off.
Bingo.
All right.
Did I just leave the music playing the whole time?
In the background, you got to have something to listen to in the background. Yeah.
All right, man.
All right.
What do we got, Jerry?
It is the weekend again, and it's almost May, 25 April 2021. I forgot the quote. Basically, I was gonna do, and I got sidetracked because I actually got onto something a little more relevant. But the
You don't have a quote in there.
No, I do.
Oh, okay.
But sell in May and go away. So
Yeah.
that'll have to be next week
Okay.
because I think we got one more. It'll be very early in May, and it sort of relates to one of the questions that the people were asking that we'll get to later. Was a lot of our folks were expecting an alert last week, and why didn't we get it? Seasonality. In terms of seasonality, this tends to be the time when the market does the worst throughout the year, and that's kind of where the thing comes from. Sell in May and go away and come back. It wasn't originally Labor Day, but that's how it's turned into. But I think we'll do that next week. This week is the second of a 2-week series that we started last week, right? Last week we talked about risk, sort of the conventional view and what our view is. And this week is going to be getting to this idea of personal risk tolerance. We talk about it all the time. So what does it mean actually? What does it mean in general? What do we think it means? Is it just based on age? Is it the same for everybody? Those are some things to think about as we go through this. But I took this quote from Urban Dictionary. Not the best place to find quotes that really matter, but I thought this was kind of funny. So, personal risk tolerance, also known as PRT, a term used by investors or degenerate gamblers to rationalize.
Well, they have to be degenerate. Jeez.
Well, apparently not regular gamblers. Apparently only degenerate gamblers. To rationalize betting every dollar they have, and sometimes borrowed funds, trying to score a big win. So an example is, I maxed out 3 credit cards, took out a second mortgage on my parents' house, and asked my roommate to front me next month's rent, all for this trade. Don't worry, it's within my personal risk tolerance.
Yeah.
The trade, right? I mean, so that the thing here that we're going to be talking about is it's your personal risk tolerance as opposed to market risk.
2 very different things.
Hugely different, and they relate as we'll see. Okay. It was a mixed week for the market. This was the first. The last 2 weeks were all green, if you recall. Every C, S, I, and F. The previous 2 weeks were all green. This week we took a little bit of a break. C fund was off a little bit, 0.13. S fund was up a little more than half a point. I fund was also down, and the F fund had actually a really big week. Okay. So, like I said, last week we talked through the definition of risk, talked about the conventional wisdom and the GrowMyTSP perspective of it. This week we're going to talk about personal risk tolerance. So how it's personal to you, how it changes over time, and how it affects the way that you invest in TSP. Then we're going to take a look at GrowMyTSP's perspective on risk and your personal risk tolerance. There's no right or wrong answers here. At the end of the day, it really comes down to making informed investment decisions and being able to sleep well at night. The bonus chart is going to be Peloton. We talked about Peloton a couple of weeks ago, I think. So this is basically an update. But this past week, Peloton's down almost 20%, and it's set up for a really, really good trade kind of long term right now. Completely outside of TSP, obviously. So the C fund short-term perspective chart, we are still firmly in the middle of the fifth leg channel. So our bias is still that prices continue higher. We showed this chart last week. We're going to do it again this week, kind of updated. These are our guidelines, and that's kind of really, it's the short answer to why we didn't do an alert this week, because we're still in this channel, and you have to give it a little bit of room to breathe. And then finally, we're going to switch up the perspective a little bit and look at weekly TSP charts. They're going to be 2-year weekly charts instead of the 6-month daily charts that we usually do. But we will do the 6-month daily charts in the newsletter this week. So personal risk tolerance, right? We're gonna talk about it basically with these 4 different time frames in mind, but it's really not just based on time. So what affects my personal risk tolerance, right? These things that I'm going to list, and it's not an exhaustive list by any stretch, but it gives you an idea of things to think about. They're associated with you personally, not with market risk, okay? So, for example, some things to think about. Would you consider yourself risky or conservative by nature, right? How many reallocations have you done this month? How often do you want to reallocate? How closely do you watch the market, right? That's a huge one. How closely do you personally want to watch the market and get involved in learning all this? What's the time frame that we're talking about? If you say, I have 10 years to go until retirement, how risky can I be? Or if you're talking about the market itself, if you're looking at a daily chart versus a weekly chart, it's much different, right? The timing matters a lot. This idea of, are you willing to lock in losses? I mean, a lot of people are not willing to get out on a down day. And sometimes that costs you dearly. So it's a matter of being able to juggle a bunch of different things at the same time. But most of the stuff that we're talking about here is related to your personal kind of circumstances and priorities and goals and things, not market. How close are you to retirement matters. Are you basically a buy and hold, swing trader, momentum trader, technical analysis? Do you trade? Ordinarily, do you make reallocation decisions based on market analysis or news, right? Current events, or basically water cooler gossip? So those are all the kinds of things to think about in terms of your personal risk tolerance. So let's kind of work through the 4 here, right? I have 30 years until I retire. How risky can I be? Your personal risk tolerance is going to come down to, if I have 30 years to go, I'm just building my snowball, right? I'm just beginning my government career, military career, whatever. I'm just beginning my snowball. How risky can I be? The pros of being young and having 30 years to go into retirement is, if you don't catch, particularly the tops, and you take some losses, you do have time to recover, right? It might take a while. We talked about it last week. From top to top, from 2007 it took to 2013 to get that, to get your money back. So you don't want to absorb those losses. You can make a whole lot more. You can make your account grow a whole lot faster if you're not taking those big losses. But in the background, you do have the ability to recover more than somebody who's planning to retire next year. I have 10 years to go till I retire. How risky can I be? It's the same kind of idea. It's just that now your snowball is much bigger, and the effect of the every payday when you put money into the account, the effect decreases, right, as you get further into your career. So in the beginning, how you allocate and the amount that you put in and all that's what's growing your snowball from the beginning. As you progress through your career, that becomes less important, and how you manage the IFTs become much more important, right? So at the point where you're 10 years out from retirement, you should have a much bigger snowball, obviously, than you would be if you were 30 years out from retirement. And how you manage the snowball is much more important than how you manage the new money coming in. But you still have some time to recover, and you are still contributing. So it sort of dissipates any losses that you might take. Okay, I plan on retiring next year. How risky can I be? So here's where it gets kind of interesting. If you're going to retire next year, and you're going to take out, $100,000 from your TSP because you want to pay off your house, that's financial planning. That's planning that is not associated to how do I manage my TSP. You've identified a need for that $100,000. And the answer is, you don't want to be risky at all. You want to be in the G fund,
right?
At least the amount that you need to absolutely not lose, because you're going to use it for something else, right? if you're not planning on touching your TSP, you're just gonna let it ride because you either got a second job or you did really well in the real estate market or whatever. Then how you reallocate within TSP, whether you're retired or not, is going to be quote unquote riskier, right? Because you don't need the money to use. It's what really comes down to your personal circumstances, right? What do you need the money for? Because if you're a year out from retirement, now you're thinking about what do I need to use that money for?
Right. I've grown this large pot of resources.
Yeah.
Now what can I do to use that best?
Right. I mean, at the end of the day, that's the point, right? I mean, at some point you got to start thinking about what's the best way to spend the money that I've accumulated over all this time. I mean, I've had these conversations with people that are like 70, 75 years old. How risky can I be with this and that? And I'm like, if I was 70 years old, I'd be thinking more about
who am I going to give it to?
Who am I going to give it to, right? or what's left in my bucket list that I'm going to spend it on?
Yeah.
You know what I mean? I mean, yeah, you definitely want it to outlive your life, but I mean, it live your life with it,
right.
And
that's a lot of times when people come to us with questions, they're less about managing. We help people manage a retirement account. Like that's the simple version, right? Retirement account being the TSP for us. Yep. But that's not the same thing as financial planning.
Right. Definitely not.
Because you talked about taking $100,000 out to do X with, right? You do. So a financial planner will sit down and look and go, okay, well, what else do you have going on, right? What tax implications are there? Is there a better way to solve that problem? Yep. You bring problems to a financial planner, or maybe not problems, but ideas, things you want to do, right? And they help you find solutions in your entire wealth management kind of spectrum. Yep. That is not what we do here, right? So sometimes it's very difficult for us because people will ask us these questions, and I know people think we're being flippant sometimes when we say we don't know your personal circumstances, and we're not financial planners. We don't. Right. It's not that we're not financial planners. We don't want to be financial planners. There's a big difference there too. I mean, we are hoping eventually to bring that on, but that's not something that Jerry and I want to do. We want to study technical analysis of the market to help us better manage our TSP. Right. Like that, we're very channeled at that, and we can't answer that question, right? I mean, Jerry's doing a great job of answering these questions in a kind of a generic way, but again, that each one of those people in that, right? If you were to lump 10 people in each one of those categories you're talking about, every person would be different. Right?
Yes, absolutely.
Yeah.
I mean, if you're 30 years out from retirement, but you know that you have a lot of money in your family. Mm-hmm. Your come from is going to be different.
It's totally different. So not even about a bunch. Maybe your parents or someone else set up a wealth management plan. Sure. Prior to you, right? That's something Jerry and I talk about all the time for our kids. That we wish, I mean, you're able to kind of instill in that as it goes along, so that the next generation isn't in behind the power curve, right? And so maybe you're in that situation and you're not behind the power curve and you're not worried about a down payment on a house. I mean, I haven't met a whole lot of people working in the government and the military that are in extraordinary wealth circumstances. Right. So by and large, we're all kind of generally in the same kind of setup when we're just starting out in our career. But maybe not. I mean, I talk about this guy I was in the Army with when I spent my 4 years, running around buying a car and, going to the NCO club on Friday night or whatever. He stayed at the barracks, worked out, and saved his money. Yeah. And he left with lots of money. Yeah. He manages so everybody's circumstances is different, right? Yeah.
Now that went back to the one thing we said, are you generally risky or conservative by nature?
Right.
That's an example.
Makes it totally exactly. Yeah. I would say I got a little more out of my 4 years, but
Yeah, well, you know what? At the end of the day, it's all about the story.
It's all about experiences.
It's experiences and how well you can sleep at night. I mean, if your buddy had been out, if once a week he went to the NCO club, maybe he could live with that. But if he started rolling into 2 or 3 times a week, maybe he'd be like, it would freak him out because he's spending too much money.
Right.
I just, everybody's circumstances.
Everybody's circumstances different.
So we do these coaching calls, and we're gonna put a little bit more emphasis on that. If people want to do it, you can send an email to coaching@growmytsp.com. But basically, those calls are based around fleshing out what your personal risk tolerance is. And as we've just talked about, they obviously cannot be all lumped in together. It's your personal risk tolerance.
Yeah, and they're also not financial planning.
No,
it's really
right.
focused on personal risk tolerance, right? Jerry kind of helped peel away the onion to go, okay, where do you fit into the spectrum?
Yeah. No, I've done some really interesting calls since in the past year, basically. It's usually with people that are either retired or close to retired, and we just talk about what do you want to do with that money, right? I had this one guy I had a really interesting call with. He wanted to buy some warehouse property in California, and wanted to know, like, sort of where he should get the money for it. But what did I think about moving some of his money from TSP into this warehouse real estate stuff he was trying to do? And he was like, oh no, I'm absolutely guaranteed a 20% return on that investment if I buy that commercial warehouse property. I'm like,
then do
it's a no-brainer.
I would do it.
I mean, yeah.
If you're pretty confident, and you know that's about finding your risk tolerance,
right,
your circumstances. Absolutely.
Yeah. I really like doing those calls. Okay. So on the one hand, we just talked about how your risk tolerance is personal and it's dependent on your personal circumstances and all that. And it is. But from our perspective, this is the same chart that we put up last week, but I have the same slide, and I have a couple of different charts about it. But basically, from our perspective, it's much more of a technical analysis approach, regardless of where you are in your career or whatever. So today is my first retired day.
Yay.
Woohoo, right? So yesterday was the end of the pay period. Today's my first retired day, and I'm 100% S-fund. And people are going to think I'm nuts. But
well, not if they know your perspective.
Right.
And we've got plenty of time. We're still rocking and rolling.
Right.
We're still going to keep maximizing our TSP.
Right. So what did we do? I retired, like, yesterday was my last day. But now I'm putting all my energy into this business, right? So I basically got another job. I'm not going to Myrtle Beach to play golf. I didn't retire. I moved jobs. So my circumstances is not like a retiree, quote unquote retiree, right? I'm not planning on using my TSP.
I like to call it semi-retired.
Semi-retired, yeah. I like that too.
Your boss doesn't care what time you show up, but you still have to show up.
I do have to show up. I don't have to do travel claims. I don't have to. There's a lot of things I don't have to do anymore.
But we're probably busier than you were before because most of us know that that's end of our careers in the government. A lot of times we're kind of coasting along, and that's why a lot of people stay, right? But we're probably going to be working harder now than we have in years.
There's no doubt. There's a whole lot more going on in my brain,
and that's exciting stuff for you guys that are members, because we get to actually pour a lot more energy into it. Yeah. And we've been really wanting to do this for a couple of years, so it's exciting.
Yeah. So that's sort of, if I was doing a coaching call with myself, those are the things I'd be talking about, right? So I'm not paying off my house with my TSP. I'm going to try I'm not going to try. I'm going to roll a big chunk of my TSP into, I don't know if it's going to be Fidelity or Schwab, probably TD Ameritrade at this point, but to be able to not be encumbered by the 2 move a month rule and having your trade in by noon and all that.
But still leave some in the TSP,
still leave some in TSP,
which is what I did basically. Left and there's different reasons you might want to do that.
Yep.
My reasons were different than your reasons, but it kind of ended up the same way. I like the flexibility of being able to trade in an IRA.
Yep.
But I also like the stability and some of this. We don't have a G fund anywhere else.
Right.
And you can knock it if you want to, but I wish there was a G fund.
Yeah.
There's a money market. It's not the same. But
no, not even close. Actually, I had a guy the other day I was talking to about that because you can roll back into TSP when if you're out of it, you can, and you're retired. No, not if you're retired, because this is the part I have to figure out. If you're still in the government and you have a 401k on the outside that you want to roll into TSP, you can do that.
Once you're out, though.
Once you're out, I don't know, because if you could, what he wanted to do was basically game the G fund.
Yeah.
And I don't know how far up the food chain of the help desk you would have to get to in the TSP to get an answer.
Yeah.
But if you could do it, it would be really awesome, because the G fund is giving you a rate that's way better than any money market you're going to get.
Yep.
So
I've sidetracked us as usual.
yeah, that's okay. Sorry. All right. So basically, my focus is on my risk tolerance. Basically, isn't so much related to my personal circumstances. I mean, it is, but it's maybe 20% my personal circumstances and 80% what the market's doing, which is why I'm 100% in this fund right now, because I know I can always get out of it. I watch the market every day, several times a day. I look at long-term charts and short-term charts, and I'm very comfortable getting out when, this line crosses that line and I'm out. And I'm also comfortable being 100% S because I know I'm not going to wake up one day and say I lost all my money because I was 100% S fund, because it doesn't happen all at one time, and I'm going to see it happen when it does.
See it coming.
Yeah. So again, I guess that is part of my circumstances is I know what I'm doing, which goes back to the Jimmy Buffett quote, or not, Warren Buffett quote from last week, right?
You know where you're at as. You're retired when you think Jimmy Buffett's the same as Warren Buffett.
Yeah. Yeah.
What's
I'd rather listen to Jimmy Buffett quotes than Warren Buffett quotes, but
yeah.
It was something to the effect of diversification is only necessary if you're ignorant, basically.
Right.
You have to know what you're doing, and that's why he stayed out of the tech bubble.
And that's part of what we try to provide for the members is not only the education. That's probably 80 to 90% of what we do is trying to educate people, whether they're members or non-members. That's why we do this show. But for the members, we also give what we call like a validation, which is that's what our alerts are. So if you're taking our education process and learning how to do this, but you're still like, okay, did I get the math problem right? Right? Am I thinking the right? You have us as kind of a validation to say, oh, okay, yep, I was on track, or whatever, like a version of that, right? And so that's kind of like the validate. We educate and validate, and those are two things that we try to do with our service.
Yep, definitely. Okay. So the market gains and losses apply to everybody equally, right? Regardless of if you have 30 years to go or if you're in retirement. If the market goes up 2%, your account, whatever it is, goes up 2%, or vice versa. The market doesn't care about you and your age and your proximity to retirement or whatever. So you have to factor in how you can best sleep at night and your circumstances and all that, and apply those personal things to how you manage your TSP. Of course, your account grows faster the more time you have to leave it in, which obviously that decreases as you get older. And
the compounding, I don't want to fly past that. The compounding really comes into play in our methodology, right? In the way you've set the process up of not losing money. A lot of times people lose track of that piece. Well, if we lost 30%, based on a market decline, and we were out of it, our bucket stayed full. Compounding is on our side. Right. If you dropped 30%, your compounding isn't quite as much. Now, you've still got new money, but as we talked about, if I'm a few years into my career, my real bucket is what's in the account, not the new money, because the new money is just a little bit. Right. This is supposed to be a lot of bit, and compounding. That's really why I get frustrated when I hear people talk about, well, it's no big deal. It is a big deal because your account did go down, and it's not compounding as fast because your snowball got smaller. Right. And waiting for your snowball to get big again when ours is still big because we got out. Right. So just wanted to,
that is something
the compounding piece is huge.
Yeah. No, that could be its own like main chunk of the show. Maybe that'll be next week, but. You're absolutely right.
The problem with the subject is it gets kind of boring because it's math, right? How it really works, and it's like you start to do the compounding, but once you wrap your head around it, it doesn't. Don't worry about the math.
Right. Yeah. We would need to show the math, but it's the idea that people have that and you say it all the time. I'm locking in these losses. Yes, you're locking in losses. Basically, it's a zero-sum gain at the end of the day. Mm-hmm. I mean, if at the end of the day I have 100,000 in my TSP, that is what is being affected by the next day's share price. If I took a loss that day or a gain, it matters because it goes to the amount of your snowball, right? So every day, basically, your snowball is what it is, and the math of compounding is going to affect whatever that amount is. Yeah. So you can't say. It's not. I didn't lock in the losses.
You did
until
because
I
your
sold
account.
You did every day.
Yeah, it's not. People get confused between difference between a retirement account, IRA, 401k, TSP, versus a brokerage account.
Sure.
Where I'm buying shares of stock.
Yeah.
It's true. If I don't sell those shares, I don't really take that paper loss. I don't really take that loss, right? It's on paper.
Yeah.
That doesn't work the same in a retirement account. My account balance is $100,000. If it drops 30%, it is now $70,000.
Yeah.
There's
Absolutely.
no locking in or unlocking in.
Right.
It just happened. And so our goal is to stay at 100,000 and creep up.
Yep.
Right. And not have that big swing down and wait till I get back. Yep. That's the part. And actually, Jerry and I are in the midst of writing a ton of educational articles and things to kind of do our best to get that out where people kind of understand this. Because that is if you don't fundamentally believe what we just talked about, we're probably not for you. Like if you think that there's that doesn't work that way, then you're not going to buy into what we're thinking about. Right. Because our number one goal,
it's don't lose money.
Don't lose money. And people don't understand why. Yeah. And that's why.
But again, number one goal is don't lose money. Well, then how can you be 100% S and you say that the market risk is high and how can all these things come together? Well, number one, they have to.
Right.
Because that's the way.
Because rule number 2 is
you have to be in the market when the market's going up to grow to make this compounding thing work.
Yeah.
Right. Yeah. There's a lot going on. Okay. So here's a chart that I did back in 2017, and it was along the same kind of idea as showing risk, right? So we talked a little bit about this last week. At that point right there, where the red line goes down, the price had dipped, and the MACD lines crossed, right? That is the highest risk in terms of market risk because all the price is rolling over and all the indicators are rolling over. So at that point, regardless of what your age is, the market risk is high. Doesn't mean it had to collapse 50% like it did in this case, but we had just had this huge run up, and it broke the trend line on the downside. So from my perspective, that's when I would absolutely get out. This is a little bit of a simplistic chart because it's monthly. So I know that ordinarily we look at daily, sometimes weekly, but if every once in a while you broaden the perspective a little bit to see where the real important turns are in the market. So obviously this was a really big one. This was a really big bottom. This was another big top. Another really important bottom, right? This one did not turn out to be as big a top, right, as these were. I mean, it was looking, sorry, I'm using my finger here. I'm not using my stylus, but it was looking pretty iffy right there, So the risk when the MACD crossed and the price rolled over, it looked an awful lot like it looked back here. It just didn't turn out to be that. And it was the same thing on the upside, right? We weren't going to catch the bottom in, I think it was October 02. That was there. I can't remember, maybe March 03, February 03 was the final bottom there of the tech crash. You weren't going to catch that bottom. You could look at it and say, well, we had a pretty good double bottom, which was true. It was a great indicator that once it was confirmed,
there's going to be a change.
There was going to be a change
in trend.
Yeah, but you didn't know it until really that green line passed through, because that's when, if we drew this trend line like that, that's where you could see that
once it broke the trend line,
real trend change.
It's confirmed a trend change, right?
Right. So because now you get a double bottom, and it's actually the second low was a little bit higher than the first low, and you've broken through the trend line on the upside, and it's on a monthly chart. So On a daily chart, it would look like you should have gotten in a long time ago, like maybe last week or last month or whatever.
Yeah.
On a monthly chart, it much more solidly confirms the move.
Right.
You know, after I mean, you just took a 50% loss. That's probably the bottom. And if it's not the bottom, you're going to get out if it goes below the double bottom. You know, so you can quantify your risk in there.
And drawing these trend lines like Jerry's showing, these are, very simple ways, that plus having the 10-day, 50-day, 200-day averages, on there with it tells you a lot of information and just a few little simple things that, again, that's what we're trying to, teach you guys and gals out there is to like draw your line in the sand and know, and then you can validate it with what we're doing. But it's really not that much to soak in, and really looking at it once a day is helpful, right?
Yeah, I mean, it takes a while to get the hang of it, and then once you have an idea of where you are, look, you can look at it once a day, it's no problem. Definitely, well, maybe twice a day. If you look at it in the morning, 10 o'clock.
That's probably more realistic.
10, 11 o'clock.
Yeah.
Because anything that you do...
Sometime before noon.
Yeah, right. It has to be before noon. You got to make a decision.
Yeah, we get less and less worried about it as the day goes on because it's, we can't make it
Can't do anything about it.
Can't change allocation. But we're really focused on the closing day price at that point anyway.
Right. I mean, afternoon, when you can't make any changes, okay, so go to lunch, go work out, do whatever you do, and then come back after the market closes and look at it because now this is your setup for tomorrow.
Right. Yeah, so twice a day is probably the best.
Plenty, yeah. Unless you're a geek like me and you 10 times
20 times a day.
Seriously.
We were on vacation for 4 days and couldn't keep them from looking at it. That's okay, because it's our job.
That's my job. Yeah. Okay, so this was, like I said, a chart we did back in 17, right? And the last part of it, we said that this was a pretty good buying opportunity right there in 2017 because MACD turned higher, right? We got above this high. The market didn't roll over like it did back there in 2000 and 2007, and it got back above this high. So,
and how's the volume there? Like on that up?
It's decent. You can kind of see it. It's
I can't see it, but I know you can. Now I can see it. I don't wear my glasses. I should.
Yeah. No, the volume there was decent at the end of 16 and going into 17. But once the MACD ticked higher, crossover was really good. So how does that compare with? Get rid of all this. How does that compare with what happened after that, right? So there's where we were. Maybe a little bit lower than that in 2017. And then we had that, we had a pretty tumultuous 18 and 19. We had a lot of price movement in here, right? And it was also reflected in the MACD right there. So it's easy when the MACD crosses down and the black line stays below the red line for a long time. And then when it crosses back up and it stays that way for a long time, what's difficult is when you got a bunch of churning like you got in here. And that's what it gets reflected in the prices up here. This is where it helps to use a different tool, right? So in this case, if the indicators aren't telling enough, then basically what's the next tool? If we had done the Elliott wave count, we knew one ABC was, where's my thing? One ABC for 2, 3 ABC. Get up there. This was the 4, and we're in the 5 right now. So this section, I wouldn't be too concerned about, right? It would help me sort of navigate through this churningness of the MACD. I wouldn't get scared out, basically, is my point. Which again, kind of comes back to people asking this week, how come we didn't get an alert? I don't want to get scared out of the market because I think it's going to move higher. in the short run. Okay. Bonus chart. Peloton. Everybody at this point has got to be familiar with Peloton. It's an exercise equipment, and I didn't know a media-based company, which I should have figured that out because it's more about the app than it actually is about the bike. But an exercise equipment and media company based in New York City, founded in 2012, launched with Kickstarter funding back in 2013. Okay, Peloton has been huge since COVID started back in March of last year, and you can kind of see it on the chart. I didn't go all the way back to March. This is a 1-year daily chart, and I used the closing price only. I didn't use the candlestick charts for this one because it's easier to see. It kind of takes away some of the noise if you do closing price only. So we got this huge run up, right? Huge run up here. Volume really kicks in here, and we generate the left shoulder. Okay. Then we had a bit of a pullback, no problem. We got all the way up here to 145 or so, and a pullback back to 100, right? Round numbers tend to mean things, so 100 is a lot of things happen at round numbers, and 100, 200, 300, things tend to gravitate there. So came back to 100. Keep going higher to about 170, I think was pretty much the high of Peloton so far. And we came back down to 100 again, right? RSI was pretty much bottomed out here along with the price at 100, right? That's good. RSI on the right shoulder never got back up to where it was on the high, right? Or the right or the left shoulder. So momentum is definitely waning in Peloton. And from a technical perspective, momentum is really waning. From sort of more of a fundamental way of looking at it, the need, I would think, the demand for Pelotons in your house decreases as gyms start reopening because COVID's coming to an end. So, and people are looking to get out of their house, and yeah, it's cool being virtually riding your bike with other people. But I'm not a big spin class guy, but I would think that people that like spin class like it because they're actually in the room with other people doing it.
Interacting with people.
Yeah.
It will definitely be interesting to see how the growth goes.
Yeah. So this is a pretty frightening head and shoulders pattern. And if you look at the last frightening, yeah. The last week is that last part of the red line there. You can see how we ran up from 100 up to 120. Okay, and then we got above the 10-day moving average, but we couldn't get above the 50-day moving average. We tried at least twice, 2 serious tries, but butting up against the 50-day moving average and couldn't do it. Rolled over every time. And then once it broke below the 10-day, it collapsed last week. So that's when the last time it hit the 50-day up there, say that was like $120 a share. Once it broke below that 10-day line, it was a great shorting opportunity down to where it is right now. So you could have made, say, 18% if you had shorted it there down to where it is now. Now it's really interesting because that would have been a short-term great week for you if you had made 18% last week on the short side of Peloton. But what's way more important is this long-term head and shoulders pattern. So we've talked about it before. Head and shoulders is a pattern that everybody recognizes, so a lot of times it fails. We talked about the IWM, I think, last week. It's a Russell 2000, and it pretty much gave us a failed head and shoulders pattern. Peloton doesn't look like it's going to fail at this point. So if I owned Peloton right now, and I bought it, back a year ago, if it closes below, say, 98, right? So it's at 101.07 right now. If it went down 2% and it was 98.50, let's say, I'd be out. If it got back above the neckline, I'd probably have to see it back above the 10-day moving average line. But if I owned it and I had ridden it all the way to where it is now, if it gaps down next week and closes a day below 98-ish, I'd definitely be out of it. On the other side of it, if I don't own it and I didn't short it last week and got that 18% bump from last week, now I'm looking at it and I'm going, okay, if I short Peloton now, if the market keeps going down, if Peloton keeps going down, I make money. If I short it and it goes back up, I need to get out of the trade or I'll lose a bunch of money. But it's right on that line. So what that does is really reduces your market risk, because you know if you short it right now and it goes to 98, you've made the right choice. If you short it here and it goes up to like 103, let's say, you probably made the wrong choice. So your risk is pretty minimal, because it's going to tell you really quick which direction the market's going to go from here. The technical indicators, would definitely suggest that Peloton goes lower from here. There's no guarantees, but it's a pretty good. If you were a little bit, so in terms of risk, if you're a little bit risky, if I was a little bit risky and I was buying, and I was interested in a trade on Peloton, I would short it. If I wasn't so risky, I would wait and see what it's going to do on that 100 line, and then make my trade based on whatever it did. Because you also have it's support here. You get a lot of support at 100, so it's entirely possible that Peloton keeps going up, and we end up with some kind of long-term sideways consolidation, and then eventually it breaks higher. That's a possibility too. But when it's on these lines, it's on the channel lines, those are like the best opportunities. Okay. TSP fund charts. Again, the ticker symbols: C fund, $SPX, S fund, $DWCPF. The S fund is not the Dow Jones Industrial Average. It's much more aligned to the Russell 2000 than the Dow Jones Industrial Average. It's a Dow Jones company index, but it's not the Dow Jones Industrial Average. I fund, Europe, Asia, Far East Index, and F fund is the aggregate bond index. All right. So lots of questions this week from people in the Facebook members only group about why didn't we see an alert this week. It's a little bit hard to see. I'm just going to zoom in. This is an 18-month daily chart. So you can see, and it's the C fund. You can see basically there was a whole bunch of churning on the 10-day moving average this week. It consolidated. It didn't roll over. It consolidated on the 10-day moving average. And we're still firmly in this channel, which is my kind of guide rails for where the market is right now. So that's the sort of short answer of why we didn't get an alert, because the market didn't collapse. I mean, I'm trying to stay in the market to make my snowball grow, right? I don't want to get scared out of it. In a broader picture, we've talked about it plenty. We're much closer to a major top than we are to a major bottom, but we don't know when the top's going to happen. And I'm not willing to be out of the market while it's still going up. So if your risk tolerance is different from mine, do what allows you to sleep better at night, right? I mean, I don't know how else to keep putting it. Hopefully people will be watching this show, or it'll get out and around a little bit, because it seems like every day somebody's posting in that Facebook group about these are my circumstances. What should I do? And I wouldn't be asking those questions in any Facebook group or anywhere else on the internet. I mean, that's Yeah. What are you going to do with the information that they give you? Like, I don't know. It's like asking for a stock tip.
Right.
But this is why. This is why we didn't see an alert last week. Okay. So the weekly charts, we usually do daily. We're going to do daily in the newsletter this week, but to broaden the perspective out a little bit, this is a 2-year look at the C fund weekly, meaning each one of those ticks is a week. So if you're looking at it on a weekly basis, this week that we just finished, did the C fund have a horrible week? No, not really. It finished fractionally down for the week. It was down 0.13%. The low of this week did not go below the low of last week. And the high of this week basically was the same as the high of last week. So we had actually pretty good reversal week, which would indicate a bias that the market goes higher from here. So I'm really not worried about it on a weekly basis. S fund is a much different chart because we just came off of let's see, the last 1, 2, 3, 4 weeks have been positive for the S fund, and we came off of 1, 2, 3, 4, 5, a 6-week triangle consolidation. So, and 3 weeks ago, it looked like we broke out of that right there. Right, that's where we broke out of that consolidation. So there's a lot more potential energy basically in the S fund right now to move higher than there is in the C fund, which is why I'm in the S completely and not the C. Having said that, the MACD turned lower back at the beginning of March. So on a weekly basis, price has basically stayed flat. It's done this consolidation, this triangle consolidation, and it's moved higher out of it. But across the weeks, months here since February, the market's been basically flat, and the MACD has turned down. So none of these tools are 100%, but it's definitely something to keep an eye on. Okay. The I fund, same kind of idea as the C fund, basically had a really big week last week, and this week it finished down, about 1/4 point for the week, but had a pretty strong reversal and finished at the top of the trading range for the week. The MACD, that's not great in terms of telling us what direction we're going to go, because it's flat. I mean, it's much easier when you see things like that because you have something to work with. And the histogram, which is the blue piece in the middle, it helps a lot when the histogram is overextended one way or the other, because when it turns, it's a good indication of which way to go. But right now, MACD is flat, the histogram is flat, and the price is continuing to go higher. So if you're in the I fund, no reason why you should be selling it at this point. F fund looks much different on a 2-year weekly than it does on a 6-month daily. Last week, we were talking about how we didn't want to see price get above that 50-day moving average, which we're looking at a weekly chart. So the blue line is a 10-week moving average, which roughly corresponds pretty closely corresponds to the 50-day moving average. This week, the F fund finished solidly above the 50-day moving average, right? And we're not quite there yet, but the technical indicators are definitely moving in the positive direction. So if you were going to get into the F fund, if you said, you know what, it's almost May, I'm going away, I want to basically take the majority of my risk off the table, because the F fund is not without market risk, obviously, as you can see here, but the amount of gains and losses you're really susceptible to in the F fund is really minimal. So the The setup is pretty good. If you're going to go on a vacation for a month or two, or you just don't want to watch the market anymore for a while or whatever, moving to the F fund at this point is good, because it looks like we've hit at some kind of short-term bottom here, and with the technical indicators moving up, and we're above that 50-day moving average line. From a market perspective, it's a good place to be if you want to decrease your risk from the stock funds.
Right, and that's just the way it's playing out now. It's not always that way.
Absolutely not.
And I will point out, I think we talked about this last week, where we're putting our performance page together. I know I keep talking about it. We'll get it up there. We're trying to tweak it. Anyway, the point is we were able to see that there are a few times in the past few years in recent year, where the rest of the market was going down. The F fund was only slightly increasing, but we were able to get a positive return because we were in it,
right?
And we weren't in the other funds. So sometimes, the F fund is kind of like an anomaly for us, or not, I wouldn't say an anomaly, but like an outlier.
Yeah,
it's definitely not one of the key fundamental funds that we're going to be looking, getting in all the time. Right. It's going to be CS and I. Every once in a while, F is there to kind of come through for us.
Yeah, it basically, in my mind, the way I kind of think about it, the G fund, there is no market risk by law.
Right, zero risk.
You can't have a negative quarter by law in the G fund. So if you've taken all your risk off the table versus the F fund, which does have some market risk, but also gives you a little bit more return than the G fund. I'm looking at it like, is the risk, this is a different perspective of risk, but is the risk reward ratio now worth using one of my 2 moves a month to go into a fund that at best, if you look at the chart this week, it looked like it was a really big week, right? It was 0.18% of a move. And that was a good week.
Right. Yeah, it doesn't have the same big swings as
Right. So
but it's useful sometimes. It's useful sometimes.
Yeah. From a setup, a chart setup, this is great. For a chart setup, it's great. If I was going on vacation and being gone for a while and I didn't want to look at the market, I'd probably definitely say 50-50 F and G, honestly, and just let it ride till Labor Day and come back and see what's going on in the market. It's just a possibility. So I'm not going to do that. I'm not going on vacation. I'm not. So
because we look at the charts on vacation.
Well, yeah,
but not everybody wants to.
Yeah. So again, we're trying to stimulate thought and conversation and some education, and again, the alerts, because people get hung up on these alerts. I'm not telling you what to do with your money. I'm telling you, A, what I am doing with mine. Yeah. But B, it's an educational process. My lines in the sand are different than yours,
Right. Yeah. So. And based on feedback, we'll see how this goes, but we I'm hesitant to say this out loud because I don't want to be held to it, but there's been some thought of so I've been playing the TSP plus IRA game, and now Jerry will be also in both. And we have to put on different hats for those two things because there's different rule sets. Yep. So, being able to say what we're doing in our IRA, that's a mouthful. It's a lot of R's in there. It could be useful, but it's also, you have to take it with, just like this, with a grain of salt. Like, hey, this is what they're doing. I don't want to necessarily say, hey, this is what you should do. Right. And it's usually very similar. I will say that by and large, I reallocate my IRA exactly the same way Jerry allocates his TSP, mostly because I'm looking at the same charts he is, and yes, that's where you want to be regardless of which one I'm in. The only difference I would say, and because the rule set is different, I can kind of let the day play out. Yep. Where I can make that reallocation later in the day. Sure. I don't have to make it by noon, so I can hang out and kind of watch, whereas Jerry's got to make a game time decision at 10:30 or 11 o'clock. Yeah, I might hold out to 1 or 2 and get some better confirmation or whatever. And we're always talking about the way it played out that day. So those are the that's the flexibility you get from being in an IRA. And I've actually found people now talking to a lot of people, whether they're members or not, that are actually doing both while they're currently in. Yep. Because the IRA, you can't put as much money in there, right? And you don't have matching. So take advantage of the matching.
Absolutely.
Take advantage of it. Don't lose out on that. But everything above that, it's again personal circumstances. Whether you really want to be engaged with the market, and you could play a separate retirement account, your IRA, and you have that flexibility, right? Yep. So anyway, if you have any questions, please put them in the comments section of Facebook or YouTube, wherever you catch this video. Appreciate you guys watching, and if you like it, share it with your friends.
Definitely. One more thing I forgot.
Alibi.
I had a comment, a question about the VIX and the CBOE, and I didn't have time to do it on this week's show, but we'll do it next week.
We'll get to it.
We'll get to it next week.
All right, guys. I hope you have a great week.
Send in questions.
May the market be in your favor.
Hey, the force be with you. Very weird not having a stylus in my hand.
I know.